Thank you for joining Market Insights. I'm Jack Thurman, president of BKD Wealth Advisors. As a wealth management firm, we're very interested in the questions and concerns of our clients raised by the changing economic environment. Today, I've asked Jeff Lehman, our Chief Investment Officer, to address some of the common questions we're receiving from our clients concerning the possibility of a double-dip recession and how we're allocating their assets with this possibility in mind. Jeff, explain what a double-dip recession is and what are your thoughts of the possibility of us seeing something like this over the next year?
Well, Jack, simply defined, a double-dip recession is a situation where the economy goes through 2 or 3 quarters of rebound from the prior recession and then softens again and dips into contraction, kind of extending out the downturn in the economy. And we look at the economic data that's come in over the summer, and clearly it's softened, yet we still would put the probability of a double-dip recession at less than 30%. When we look at some of the major industries in our economy, like housing and the auto industry, these industries have declined so much over the last couple of years that it's difficult to see them declining much further.
Much of the recovery that we have seen is based on artificial stimulus from the government. What happens when that stimulus fades away?
Sure. Well, it's true that the economic rebound that we've experienced over the last 12 to 18 months has been led by governmental stimulus. That's very typical in an economic recovery. In fact, that's the purpose, as the term stimulus implies, is to get the economy moving forward, act as a catalyst for the private sector to then be able to move forward on its own. Certain industries are doing that now, but at various stages of progression here. And so when we look at conditions generally, we think they're still improving at different paces for different businesses, but we expect the rebound to continue, although at a slower pace than what we've seen in past recoveries.
Our clients are still seeing a whole lot of uncertainty in the press, feeling it in their stomach. With all this uncertainty, isn't it better just to move all the stock money off into cash and just wait for this economy to strengthen and certainty to build back up that we're going to have a strong business economic environment?
And there's 2 important things to know, I think, with regard to your question, Jack. And the first is that the stock market is what we'd call a discounting mechanism. And what that means is that it's factoring in information that's known today and available today. So when we look at the valuation applied to stocks at about 13 times earnings, it's considering the fact that economic growth has slowed, is expected to slow in the coming months, and that's built into prices today. That's why they're selling at a reasonable valuation. So even a slight improvement in the economy or economic expectations will probably cause stock prices to go up. So that's a very important thing to understand. The second point is that our companies in the U.S. are operating really in a global economic environment today. And the reason that's important is that companies have the opportunity to grow their businesses outside of the borders of the U.S. In the second quarter, S&P 500 companies, the largest U.S. companies, sold almost half of what they produced to foreign buyers. Given that many of these foreign economies are growing faster than our own, that gives our companies the potential to grow at a much faster pace than what the sluggish U.S. economic recovery would imply is possible.
You still talk about sluggishness. You talk about 30% probability of a double-dip recession. What if that 30% occurs? Will we see the market respond like it did basically in late 2008, 2009 and have a plunge?
And you know, those memories haunt the individual investor today. What we went through in late 08 and early 09 was one of the most difficult market environments in several generations. We don't think that that's likely to occur again, even if we do go into a double-dip recession. And the reason is that the environment at that time was one of extreme instability in our financial system due to large losses experienced by banks and other institutional investors. We think that one of the most important things that the government did at that time was implement the TARP program, which allowed banks to recapitalize themselves and get on firmer ground. We think that they still have troubled loans on their books that they'll have to continue to work through, but most of them have returned to profitability and are operating in a much more normal environment. And they're key to the growth potential of our economy. The availability of credit is very important. So even if we re-enter a double-dip recession, we don't think that the downside is anything like what we experienced 18 months ago.
So what you're saying is, despite what the press is saying quite often, is that we have some distinct possibilities of this economy coming back, the markets coming back. And with that in mind, how are we positioning our portfolios?
Sure. Well, we took advantage of some opportunities in the asset allocation structure, or the way that assets are diversified, about 18 months ago, to expand diversification to really 13 global asset classes. And we think broadening diversification today in this global world that we operate in makes a lot of sense in both managing risk and increasing return potential. We continue to refine those allocation models today. The other thing that we did coming into 2010 was we reduced the exposure to stocks in favor of bonds, not because we expected a large downside movement, but more so because we thought volatility would increase as the economy continues to heal in fits and starts. And we really believe we've seen that play out this year. We keep that in place, and we think that our clients have benefited from not only the increased income in the portfolios, but also price appreciation from the bonds. And at the margin, on the equity side of the portfolio, we've incrementally increased income-producing stocks, higher dividend-paying stocks, because that bird-in-hand return is appealing in this environment. And also, we tend to see higher quality companies in that area as well. So we think that's a desirable benefit too.
So we're not just sitting back kind of hoping the market responds well. We're really trying to posture the portfolios in such a way that we know there's uncertainty, but we want to make sure that we're taking advantage of those things we are fairly certain about. Jeff, you've gone through 87, the crash of 87, the recession of early 1990s. You've gone through the tech boom and bust. You've gone through now what is called the Great Recession. Do you have any words of wisdom going forward for clients in the midst of this uncertainty?
I think that the most important thing for an individual investor to do is to work with their advisor to determine the portfolio structure that best fits their needs and objectives, and then stick with that through thick and thin. These markets, the economy, they're very cyclical. Some of these cycles tend to be more extreme than others, and that's what we've had since 2007. Yet making investment decisions based on the peaks of fear or the peaks of elation are usually not the most successful strategies. We believe sticking with a disciplined approach makes much more sense and increases the odds of success.
Great. Thank you, Jeff. As market events occur and regulations change, which impact our clients and raise common questions, we will continue to provide these informational broadcasts. For more information, please visit our website at bkdwealthadvisors.com.